Have you ever dreamed of a life where you never have to work again? What if I told you it's not about grinding away at a job you hate or pinching every penny? Every so often, the US Treasury throws open its vaults. And for those who are paying attention, it's a golden opportunity to walk in and claim your share. This used to happen every 5 or 6 years, but now the game has changed. When that moment arrives, there's no time for hesitation. You have to be ready to seize it, because the rewards can be life-changing. Just a year ago, we saw one of these moments. Now, the whispers on Wall Street are turning into a roar. The next opening is just around the corner, less than a month away. The consensus is that the Federal Reserve is about to be forced into a corner, with no choice but to slash interest rates this September. The second that happens, US dollar assets are expected to explode in value. Buying in now is like getting a front-row ticket to the concert of a lifetime. The theory is simple. Once the rate cuts start, you just sit back and watch your wealth multiply. But is it really that easy? Hello, everyone. Welcome to Stewardship Finance Academy. Let us ask a critical question. Can you make every company in America instantly more profitable overnight? Boosting their revenue all at once is a fantasy. But what if you could slash their costs in a single move? There's a way. Cut interest rates. A rate cut is like a shot of adrenaline to the heart of the economy. Suddenly, borrowing becomes cheaper. Company balance sheets look healthier. And the stock market, in theory, should go to the moon. It sounds like the ultimate cheat code, doesn't it? But here's where the story gets complicated. How do you force the Federal Reserve to play along? The US government might point to the economic data, but what if that data is telling a story that isn't true? It now appears the government itself is admitting that the numbers the Fed has been relying on for the past 3 months were flawed. If that's the case, every decision to hold off on rate cuts was based on a lie. So, the Fed is facing a choice. Open the floodgates and cut rates, or stand by and watch the US economy teeter on the brink. The narrative is almost too perfect. The government, some would say, is manipulating the data to corner the Fed. Look at the non-farm payroll numbers, revised from a reported 140,000 new jobs down to a mere 10,000. It's as if hundreds of thousands of jobs vanished into thin air. Even Morgan Stanley has raised red flags, suggesting that the 3% GDP growth we've been hearing about is a mirage. The data says one thing, but the reality on the ground is that the economy is weakening. How is this possible? It's a clever trick. To pump up GDP, you don't need more spending or investment. You just need to tweak the net export figures, make exports greater than imports, and GDP rises. And how do you do that? Slap tariffs on everything coming into the country? Suddenly foreign goods are more expensive, imports plummet, and the numbers look great. But it's an illusion. You make things too expensive, people stop buying. They might have more money in their pockets, but are they truly richer? The US runs on imports. Do we really expect Americans to give up their way of life and start building factories to make their own goods? Even if the data is flawed, can it really force the Fed's hand? And here's the million-dollar question. Would a rate cut even work this time? If the Fed was so eager to cut rates, why did they stop so abruptly after the last emergency cuts? Your financial future could depend on understanding the answer to that question. If you want to be on the right side of this, to not just survive but thrive, then you need to stick with me. Like this video, save it, and let's figure this out together. First, let's talk motive. Why would the US government risk its credibility to force a rate cut? It's simple. Power. To stay in office, they need a win. Congress has capped the national debt at $37 trillion, and we've already hit that limit. The government can't borrow another dime. So what's the play? They have to prove the economy is strong enough to handle more debt. That's where the doctored economic data comes in. With that, they convinced Congress to raise the debt ceiling by another $5 trillion. The government immediately borrowed $1 trillion of that. Think about that. They can borrow a little over $1 trillion a year, but they're paying $1 trillion a year just in interest. It's like taking out a new credit card to pay off the interest on your old one. This is where the Federal Reserve comes in. A mere 1% rate cut would save the government $370 billion in interest. A 2% cut would save them nearly $740 billion. This is the power the Fed holds over the country. It's a stranglehold. They don't cut rates, the government goes broke. And it's not just the government. High interest rates are crushing American businesses. People with money are just sitting on it, earning interest in the bank instead of investing in the economy. Struggling economy means an angry populace, and that's the last thing an incumbent government wants. The message to the Fed is clear. You will cut rates or we all go down together. With the debt ceiling raised, the government no longer needs to pretend the economy is strong. Now, it's all about getting those rates down. They're openly admitting the data was weak, putting the Fed in an impossible position. But is the Fed really just an innocent bystander in all of this? Let's play this out. Imagine a bond paying 5% interest when new bonds are only paying 2%. Everyone would want the 5% bond, right? The demand would drive the price through the roof. That's how it's supposed to work. But last year, when the Fed cut rates, the exact opposite happened. U.S. Treasury bonds plummeted. For 5 years, U.S. Treasury bonds have been in a free fall, regardless of whether the Fed was raising or cutting rates. The old rules no longer apply. High interest rates might attract a few short-term buyers, but lower rates are being met with a resounding silence. Without buyers, the price doesn't just stagnate, it collapses. Last year, the Fed tried to cut rates twice, and the bond market nearly imploded. They had to slam on the brakes to stop the bleeding. This year, with no rate cuts, the bonds have at least found a floor. But what happens if they start falling again? Why did so many banks collapse recently? Because their biggest asset was U.S. Treasury bonds. It's like your life savings being tied up in a house whose value is plummeting. When banks have to sell those bonds at a loss, they can't pay back their depositors, and they go under. A wave of bank failures would trigger a global financial crisis. It's a vicious cycle. It's not just us banks. Institutions all over the world are loaded up on these bonds. When they're forced to sell, it just pushes the price down further. U.S. Treasuries were always considered the safest asset on the planet, because the U.S. dollar would always rise to offset any drop in bond prices. But that's not happening anymore. Now, both the bonds and the dollar are falling together. A $1 million investment could turn into $800,000 in the blink of an eye. It's a double whammy, and it's terrifying. So, the Fed is trapped. If they don't cut rates, the economy crashes. If they do cut rates, the bond market and the dollar could go into a death spiral. Even with U.S. interest rates at 4 to 5% higher than almost anywhere else, money is flooding out of the country. The U.S. dollar index is down 11% this year alone. What do you think will happen if they cut rates in September? People think the Fed makes decisions based on data. If it were that simple, a computer could do the job. The market is pricing in a 90% chance of a rate cut, all based on that same flawed data. People are betting their life savings on it. But what if they're wrong? What if the rate cut happens and the market crashes anyway? We've seen it before. When the Fed was raising rates, everyone predicted a crash, but the market soared. Last year, they cut rates and the market tanked. The theories, the news, the financial reports, they're all just noise. The truth is, the game is rigged. The big players, the insiders, they're the ones who know when to buy and when to sell. For the rest of us, trying to time the market is a fool's errand. If you want to win, you have to stop playing their game. You need a system, a plan that gives you an edge, that lets you manage risk and come out ahead no matter what the market does. If you don't have a system like that, you need to find one. I'm offering one for free, but not for long. This is your last chance to get in before it's gone for good. So, what's the real story here? Last year, before the September rate cut, U.S. Treasury bond ETFs actually went up 18%. Why? Because everyone believed the hype. They rushed in, buying up bonds, thinking they were getting in on the ground floor. The rate cut happened, and the floor fell out from under them. They were trapped. And the story used to justify the crash was that no one wanted to buy us debt anymore. But is that true? Who is the biggest holder of U.S. debt? It's not China or Japan. It's the Federal Reserve itself. The U.S. can never default on its debt, because the Fed can always print more money to pay it off. They're the ultimate backstop. So if the Fed can print money, why didn't they step in and buy up the bonds last September to stop the crash? During the pandemic, they cut rates to zero and printed trillions of dollars to buy up bonds, driving their prices up 33%. But last year, they let them burn. Why? Because they were letting foreign investors, the insurance companies in Taiwan, the agricultural co-ops in Japan, take the fall. They let them buy at the top and then pulled the rug out from under them, forcing them to sell at a massive loss. And now, it's happening all over again. It's the same narrative, the same hype about a September rate cut. The world is rushing in to buy U.S. Treasuries, thinking they're getting a bargain. But they could be walking into the same trap. The rate cut will happen, the bonds will plummet, and the big players will be there to scoop them up for pennies on the dollar. So you see, the rate cut itself is irrelevant. The only thing that matters is whether the Fed decides to print money. If they don't, a rate cut could be a signal to sell. If they do, stocks and bonds might rise, but the dollar will be toast. That's why we have to be careful while investing in U.S. dollar assets. While the U.S. market was recovering from April crash, markets in Europe, Hong Kong, and Taiwan were soaring. Why would we bet on a rigged game when there are better opportunities elsewhere? The U.S. dollar is on shaky ground, and there's a world of opportunity out there. If you want to learn how to find it, how to build a strategy that works for you, then you need to act now. This is your moment. Don't let it pass you by. If any of this was confusing, go back and watch my first few videos. It's all connected. I can't re-explain everything every time. The world is getting more chaotic by the day, and I can only share so much in one video. But what's coming next is the most important part. Subscribe, turn on your notifications, and share this with everyone you know. I want to see you all achieve financial freedom. If you have questions, leave them in the comments. If even one thing I said today helps you live a better life, then it was all worth it. I'll see you in the next video.